My name is Claire Jones. I'm the International Economy Editor of the Financial Times, and it's a delight to be here in Vienna today. I'd like to thank the organisers for inviting me, and thank the panellists too for coming along, and thank you, the audience, for sticking around on a Friday afternoon to hear us talk about public debt in Europe. Barry, thanks for kicking off the session with some, I think it was a really fascinating presentation that gave us a great sense of what the history of public debt in Europe has been. It also, for me, as the title of your book suggests, that over the centuries there's been a strong case for sovereign debt. I'd like to turn now to the first of the panellists, Daniel Gros, and ask, Daniel, do you think that case for sovereign debt remains today?
I have the impression that in this case, history is misleading. I totally agree with Barry's analysis that public or the development of a public debt market did indeed help develop financial markets overall, and that some infrastructure investment, pioneering in some cases infrastructure investment by governments was indeed part of the European success story, part of the great divergence that he mentioned. But this time is different, if I may say so. Today we have very developed financial markets, not only for government debt, also for private debt. And just to give you an idea how times can change, I think it was about 20 years ago, if I'm right, Barry, that there was a discussion in the United States about what happens if public debt disappears. Because the federal government was running large surpluses for several years. And if you had just a straight line forward of the same conditions, then public debt would have disappeared. And it didn't much to affect financial markets, which continued to work anyway. Public debts these days come about because very large social expenditure is or cannot be financed by taxes because of domestic political obstacles. And since we have so much public debt, I think something which Barry mentions is that public debt remains a bedrock of financial markets. But it also implies that the cost of not getting it right, the cost of having financial markets doubt the solidity of the government, these costs have greatly increased. And I think that should be one of the guiding concerns of fiscal policy during the present crisis.
Okay, so just a lot for those remarks. You're going to have to get used to this mic. So it's clear, I think, from your remarks, Daniel, that you think there's some case for setting us on a sustainable path when it comes to sovereign debt levels, at least in some corners of Europe. What I liked about the presentation, Professor Eichengreen, was that you made very clear that when it comes to sustainability, it's very much IMF, it's mostly fiscal. So given that we need fiscal consolidation, really, if we're going to see debt sustainability, how do you handle that at the moment, given the tricky political economy?
There are 2 points. First is, if you want, the contingent situation in which we are right now. Perhaps let me put that aside, and I will come back to that later. In the longer term, actually things look much easier than the long-term episodes which Barry Eichengreen has so nicely illustrated. In the United States, for example, the case which he mentioned, and also in the UK, the growth rates and the nominal interest rates were of similar order of magnitude, right, and didn't really help much. But we are now in a situation where most government debt, long-term debt, has already been placed at very low rates. And if government were prudent, they would follow the Austrian examples of issue a 100-year debt at, I don't know, 1.6%. And if you can get that in, then you're basically home free. Then historic experience shows that it's very unlikely that for the next 100 years we'll have an inflation rate that low. And even with minimum growth, we'll have a very nice positive snowball effect. So I would say that at the present juncture of the euro area, looking forward with that, I think the average maturity is 8 years, pre-financed at reasonable low rates, I think there's a case to be made that it's now or never. Looking forward, let me make one comment also on the present situation, which was the object of Barry's last 2 slides. My calculation would be slightly different. I would say we have now a year, perhaps 2, with very high nominal GDP growth rates. And even for Italy, I think we arrive around 6%. Nominal GDP, right? Not real. If you start off with a debt to GDP ratio of 150%, 150 times 6 makes 9. So just through the growth effect, you can reduce your debt ratio by 9 percentage points of GDP. And you need to do almost nothing on the budget deficit. So I would repeat, if not now, when? So I think really now is really the time to start on the journey, which will be long, but to give it a good take a good first step in reducing debt ratios by not using all of the fiscal room for maneuver that Barry mentioned for expenditures which might be necessary, but not necessarily have to be financed by debt.
Okay, so after the panelists have all had their say, we'll return to Professor Eichengreen to address some of the critiques. But I'd like to turn now to Daniela Gabor, who's a professor of economics at the University of the West of England in Bristol in the UK. Now or never is quite a bold statement, I think. Daniela, would you agree?
Thank you for inviting me first, the organizers, and it's a great honor to be back here in Vienna. I'm Romanian, so there is a particular pleasure in being here. Claire has given me a sort of a task to try to be provocative, so we keep you awake in the afternoon. So take my comments in that spirit. Yes, I could blame Claire. Well, blame Claire. And I already want to, thinking about Daniel's remarks, I already feel like being a little bit provocative because he reminded me that Alan Greenspan, who was the chair of the Federal Reserve in the years when Bill Clinton was intent on paying down public debt, he was horrified of the prospect that we wouldn't have public debt in modern financial systems. And when some of the more conservative members of the board were proposing to him to have asset-backed securities or mortgage-backed securities as the AAA-rated tranche as an alternative, he didn't think very much of it, and then 2008 came, and we saw that Alan Greenspan was right about something at least. But going back to my original provocative remarks, I want to say that, this morning, and if you think about what the discussion in Europe, we think about Zeitenwende, right? And I don't speak German, but now I have learned to pronounce this word, I hope correctly, and it means a turning point, right? And I think I hear the word Zeitenwende, and I ask myself, why are we still asking the same question in Europe, which is, how do we reduce public debt? And what I want to do in the next 3 minutes, if Claire allows me to, is to say that it's now or never to stop asking this question and to have a Zeitenwende in the way that we think about public debt in Europe, but also elsewhere. And to convince you about that, I want to give you a number, right? Because we are economists and we operate with numbers, and this number is 9.2 trillion euros. It's a big number, right? 9.2 trillion euros, it's a big number. It's the overall size of the European repo market, which is the European money market, that is the bedrock of private credit creation and the modern financial system in Europe. Now, 9.2 trillion euros money market is a money market where banks and institutional capital lends to each other against sovereign collateral. 2 out of 3 euros lent through this trillion or 10 trillion market are circulating sovereign bonds. And to give you a sense of the proportion, the ECB balance sheet, which many probably in this room as well are keen to shrink, is around 600 billion, and the European bond market, the outstanding value of the German government bond market is around 1 trillion, right? So the order of magnitude is significant, 10 trillion. This is what we have. And why does this matter for debates or for the Zeitenwende in public debt? And I want to take you back to the origins of the Euro project and to Alberto Giovannini, who was the architect of financial markets in Europe. Alberto Giovannini said, what we want to see in Europe, and what he delivered actually, is the state becomes a collateral factory for modern financial systems. And that means the state provides government bonds to support the functioning of the modern financial system. And the implication of that, and I urge you to read this 2016 speech from Benoît Cœuré when he was at the ECB, the implication of that is that government bonds do for market-based finance what ECB bank reserves do for the traditional banking system. But there are some costs coming with that. When you become a collateral factory for private finance, you don't only enjoy liquidity, but you're in the position or under the threat of enjoying cyclical liquidity. That is, during bad times, when there are problems in the financial system, you might have spillovers in the government bond market. And we know that Mario Draghi's whatever it takes. We know that Christine Lagarde's targeting the spread, or about the European Central Bank recognizing that government bonds are fundamental to financial stability in Europe, fundamental to the functioning of the private credit system in Europe. And from this perspective, I want us to go back to the 9.2 trillion and to say, what if there is not a question of how to shrink public debt, but the question is, perhaps the modern financial system can accommodate higher or structurally requires higher debt to GDP ratios. It just needs more public debt because this is how it functions, right? And if we start the conversation by saying, how do we shrink public debt while at the same time we shrink the amount of bank reserves in the central bank reserves in the financial system, we're basically going or under threat of generating contagion in the European repo market and generating financial instability. So that's my provocative point for now. I think we should instead be asking what kind of mechanisms of coordination between the central bank and the Treasury we need to put in place, given that the Treasury has become a collateral factory for modern finance.
So I think we've heard Daniel give us the case for why it's now or never. You've given us the case for why it's essentially never if we still want to have a private credit market. Now, I'm sure there's going to be lots of thoughts on that amongst the panelists and in the audience too. But one thing I'd like to ask you now is also that the presentation touched on the idea that public debt is something that we turn to in emergency situations. A lot of people would characterize the current environment as an emergency. We just come out of one emergency, we're seeing another emergency. I mean, how would you, as an economist, think about the economic outlook in Europe right now?
So this is my second provocative point, and it's probably more provocative than the first one, because I want to argue that perhaps we need more public debt rather than less public debt in Europe. And the reason for this is to think about what is the dovish consensus in Europe, at least in the Eurozone, but in Europe, I think in general, probably in the US as well, is that we need monetary tightening. We need the ECB to raise rates at whatever pace you think and with whatever basis point margin you think. We need the ECB to deliver monetary tightening, and we need targeted fiscal support, right, for poorer households who are hit by the increase in the cost of living. This is the consensus, and as a Keynesian economist, I'm ashamed to say, I want you to think about the long run, not only about the short run, right? In the long run, the Europe needs, and this long run now is 10 years rather than the next 6 months, and this long run, we heard this morning from the energy, from the Minister of Energy of Austria, but you hear it in other places in Europe, we need a very rapid rapid transformation not only of our energy systems, but we need a rapid decarbonization of all sectors of the economy, not only because of the emergency of the climate crisis, but also because of questions of energy security. That means that somebody will have to pay for this and somebody will have to organize this. Now, trying to push fiscal austerity at a moment when we need massive investments in energy and other areas of the economy that need to be decarbonized, I think it's the wrong way to go about it. It means that we will probably not achieve any 2030 target on decarbonization, and I don't want to preempt your remarks, but that would be my logic for thinking about leaving aside the question of consolidation. This is the wrong time to ask this question. I think you should never ask this question, but okay, for now, let's just assume that we collectively agree that at least we don't ask this question now because we are in Europe and political compromise is the art we are still developing. I would just like to suggest we cannot have a small green state solution because we need massive public investments in at least energy decarbonization. The private sector will not deliver that because the private sector doesn't invest very much in a contraction, and this is what we are going to see in Europe. Plus, carbon contracts for difference in Repower Europe are not going to take us very far. I'll stop.
So thank you, Daniela. Felt like you really needed encouragement to be provocative there. I mean, I feel a bit let down personally. Margit, I'd now introduce Margit Schratzenstaller-Altzinger, who's senior economist at WIFO, who's, you've also got some thoughts on the green transition and where that fits into the public debt picture. Where would you agree with Daniela and perhaps, to be provocative, to disagree?
Yeah, first of all, let me thank you for having me here today, and let me congratulate the WIW, which has a lot of historical connections to WIFO, to its 50th birthday. I think this is a very nice event you have here. Those here in the audience who know me know that I'm not the provocative type, so I hope not to bore you too much with my intervention. And first of all, let me say that I very much enjoyed Barry's, I don't know if he sees me here, presentation, like the book itself. And I would like to address one aspect which he briefly touched upon, but which I think, together with Daniela, is of tantamount importance to cope with one of the key challenges in Europe, namely the question how to secure sufficient green public investment in Europe and sufficient green investment overall in Europe to manage the urgently required green transition. You are all aware, I think, that the Green Deal, which aims to make the EU climate neutral by 2050, and which foresees to reduce greenhouse gas emissions by at least 55% by 2030 compared to 1990 levels. The additional need for private and public green investment across the EU, the green investment gap, to achieve this stepped-up emission reduction target has been estimated at 360 billion per year until 2030 by the Commission in their impact assessment in 2020. There is a more recent communication by the Commission from October 2021, where they mention an estimate of 520 billion euro per year for the total green investment gap, which would correspond to 3.6% of EU GDP. And I see Daniel's skeptical look, and I'm aware that all these figures are, of course, hard to estimate, and they rest on numerous assumptions. But I think it's obvious that the green investment deal is the green investment gap is really huge, and that it requires massive green investment in this decade plus. It was mentioned before already, the war in Ukraine implies the need to accelerate green investment in Europe to get independent of fossil energy. It is also obvious I think that a part of this green investment gap needs to be closed by green public investment. Guntram Wolf, I wasn't present there, but I know the publication he was talking about, the publication about the Green Fiscal Pact. He estimates the yearly green public investment gap between 0.5% and 1% in Europe. Now the question is how to finance this public green investment. A smaller part will be financed by EU sources. There's the climate investment, which is financed through the Recovery and Resilience Fund. There are the also rather small green investments financed within the multi-annual financial framework of the EU, and potentially there is also the Repower EU plan, which was recently proposed by the Commission, which foresees to make available the remaining 225 billion euro in loans provided through the RRF that have not been requested yet by EU member states for investment that should make member states independent of Russian oil and gas supplies. But the larger part will have to be financed by member states themselves. There is, of course, the option to direct a part of public spending towards green public investment. One hot candidate would be to dismantle environmentally harmful subsidies and to spend it for green investment. But I think this is not sufficient, and I think it's obvious that we will require additional deficits to finance this public investment. Now, we all know that the pandemic has caused large deficits and has considerably raised public debt levels, and in addition also the war against Ukraine will burden public budgets in Europe. So, but I think in the current situation, and it was also addressed in that way by Barry Eichengreen before, with massively increased public debt in Europe, it would be fatal to repeat the premature fiscal consolidation undertaken after the global financial crisis. You all know that during fiscal consolidation undertaken after the global financial crisis, practically all member states cut public investment, as in previous episodes of consolidation, by the way. This time, premature fiscal consolidation would not only threaten the economic recovery, but would also make the green public investment that we urgently need in the next few years very difficult or even impossible. On the other hand, of course, there's the issue that debt financing of green public debt should not endanger fiscal sustainability, also considering that interest rates for public debt can be expected to increase in the next year. So what's the way out of this? I think one of the key levers, and I make that very brief so that the other people also have some time to speak left. I think one of the key levers are fiscal rules in Europe. Right at the beginning of its term, before Corona crisis, before the Ukraine crisis, the Commission initiated a discussion process with the aim of reforming fiscal rules to account for the growing need for debt-financed green public investment. That was one of the aims of this discussion process, and since then several proposals have been formulated and analyzed in the literature, ranging from a green golden investment rule, I think Guntram Wolf talked about that yesterday, over including a green public investment definition in the existing investment exemption clause of the SGP. A third option was brought into play by Agnès Benassi-Kéré several weeks ago. She proposed a more holistic approach of fiscal rules that takes into account also environmental and macroeconomic stability as aspects. So I think the window of opportunity that has opened because the suspension of fiscal rules in place since 2020 has been just extended until the end of 2023 should be used to lead a thorough discussion and to think, to devise some mechanism how to accommodate for the green public investment that we need in Europe. Thank you.
Thank you very much for that. Obviously, you'd spent a lot of time, considering those remarks and giving us a deeper sense of where the picture is in terms of like funding of the green transition, in terms of public funding. And I think, as you say, there is this potential to create a kind of opt-out within the fiscal rules. I mean, it does feel a little bit, as a journalist covering Europe, these rules have been broken so many times that, is it not just a kind of like another fudge to have an opt-out? I mean, why not just abandon the rules entirely?
Well, I wouldn't be in favor of abandoning the rules entirely. I mean, this is more than Harald's probably field of intervention or issue of intervention. I think we have to balance, on the one hand, the need, and I totally agree to Barry, to prepare for the next crisis. Yeah? I mean, nobody wants to have the next crisis, but it's pretty sure that they will come up sooner or later, on the one hand, and to accommodate for the green public investment needs on the other hand. And I think it's really important to have some fiscal rules framework. Yeah? But I think it's not flexible enough to accommodate for the green public investment needs that we have.
Thanks a lot. And now you perfectly segued into Harald. Harald is joining us from the Ministry of Finance. Maybe it'd be possible to add to that question of the fiscal rules and the whole political economy dynamic in Europe, and maybe give your remarks on the panelists and the presentation so far.
Thank you very much. If you get me going on the Stability and Growth Pact, we'll be sitting here for a very long time. So I'll have to resist that temptation. I'll talk a little bit about it. Maybe some general comments on the contributions so far. Unlike Daniel, I remember the time when debt was thought to be disappearing a little different, because I had another perspective. For me, and I'm not a macroeconomist, I'm a financial expert or financial economist, and I remember it wasn't a market, it's true, markets did not react, but there was a concern, for instance, in the insurance industry, how you can provide life insurance in the future if you don't have sovereigns as an asset. There's also the question of a benchmark for the risk-free interest rate that you need when you evaluate projects, when you do discounted cash flow analysis. Those were all issues. I'm not saying that there would not have been a solution to them, but I'm sure these solutions would not have been entirely easy. However, I tend to think these things are secondary functions of public debt, not the primary function. You don't issue debt to have a benchmark risk-free interest rate for the insurance sector. I mean, there has to be a purpose for issuing debt in the first place, and if you don't have that, then you better not issue debt. Maybe also to be a bit provocative, when I hear things like this time is different and the times are changing, for me as a financial economist, that's usually a counterindicator that we're about to enter the next crisis. Because that's like when all the press is writing that the only way for markets is up, that's usually the sign when they're about to go down. And if we're really so sanguine about public debt, and if this time really is different, I ask myself, and maybe Robert knows the answer, why the ECB does not stop the unconventional measures immediately, because if that were the case, we would see no effect on sovereign yields. But I'm sure we would see some effects, and they would be quite horrific. So at least markets think that there's still a problem with debt, if not all macroeconomists. On the Stability and Growth Pact, Margit knows my view on this. Honestly, of course, you can argue whether the numbers in there are right, whether the 60% or the 3% have any meaning. On this, I happen to think the question is misplaced, because to us in Austria, the SGP is there to address the risk of moral hazard in fiscal policy. And just like Basel and banking regulation and the things we did after the financial crisis have been done to address the issue of moral hazard in banking, the SGP serves the same purpose in the public sector. And that's why asking whether the 6% or the 3% are correct or not is just as misplaced as asking whether 8.5% core equity tier 1 in the banking sector is exactly the right figure for a capital buffer. That's not the point. The point is that you credibly address moral hazard. And I happen to think, and I have lots of reports from the European Fiscal Board to back me up, that loosening the rules now would send exactly the wrong signal. And 14 years of work in the European Union have taught me that we've never really been too early in consolidating. We've always waited for too long, and if you look at the reports of the Fiscal Board, it's completely clear. And when we decided to be more flexible, those decisions were not driven because we had wise economists at the steering wheel, but it was done for political considerations because we did not want to embarrass France or Germany. So here, I mean, the argument of sound macroeconomic steering with fiscal policy, it just doesn't wash, at least not from my experience. We are skeptical for the reasons that I mentioned. And we also think that the SGP proved during the COVID crisis and the financial crisis that it actually is quite flexible. I mean, you have the rules, that's true, but you also have, I think it's 150 other relevant factors that the Commission can use to deviate from the rules. So if that's not flexible, I'm not sure what flexibility actually is. If anything, maybe we should have more transparent rules, because me and my team, for many years, we've always been trying to figure out how the Commission comes to a certain assessment for a certain country. In many cases, it's the other relevant factors, where they say, okay, debt is above 60%, but there's this other relevant factor, and that's why it doesn't matter, and why we are not going to open an excessive deficit procedure. Yeah, I mean, the one issue where I would agree that a reform would be desirable is in actually reducing the complexity of the SGP. But again, that's easier said than done.
Thanks a lot, Harald. And I want to turn to Barry at some point, but I think first of all, Daniela, I think it's probably good to give you the right to reply to Harald before I do so.
No, just one remark. The secondary function of public debt for the financial markets that you mentioned, that can easily be satisfied without having any net public debt, right? The government can just have a sovereign wealth fund and issue debt. The Norwegian government, if you look at the statistics, has public debt, I don't know whether 40% of GDP. Of course, it sits on a wealth fund on the side. So I think the need to issue so-called safe assets is no reason to have net public debt that can be arranged by appropriate financial engineering.
Then maybe I'll say something on the primary function again. To me, issuing debt is a way of intertemporal risk smoothing. And for that purpose, it can make sense. But you have to be careful that you don't try to shift all the risks into the future, because at a certain point, this strategy will not become credible anymore, and you basically, you run into a default because nobody believes you can finance what you have paid for. But that intertemporal risk smoothing is, I think, a very important function. And if we think that more crises are coming in the future, that would argue actually for creating the room for maneuver now and consolidating instead of the opposite.
Just one additional question that I'd like to ask you. I mean, the 100-year bond has got a lot of attention, clearly, on this panel. I mean, how do people in the finance ministry feel about that now? I mean, you played a bit of a blinder in football speak, right? I mean, it looks like a pretty good deal right now.
If you promise not to tell on me, I'll tell you what I think about the 100-year bond. First of all, I mean, it's great that we can issue such long-term bonds, and our debt management agency certainly did a great job. Why did people buy it in the first place? I think it was mainly a speculative object. People were buying these bonds because they banked on further interest rate decreases in the future and huge value increases of the bond. That's exactly what happened. And then they sold it as quickly as possible.
Thank you. Now I'd like to bring in Professor Eichengreen. Can you maybe give us the sense of what you think of what the panelists have been saying so far? Thank you.
Let me respond to a couple of points. First, Daniel Gros and fiscal consolidation. Daniel and I like to argue with one another, even when we agree fundamentally. So I did make the point in my presentation about the need to enhance and restore capacity to borrow in the future. So in observing that at current interest rates and growth rates, the euro area can run a primary budget deficit of 7% of GDP is not an argument that it should necessarily. That I think there is space both for meeting the new needs that I described in my presentation and commencing that process of fiscal consolidation. I am aware of Daniela's observation that there are also recession risks that we have to worry about, that central banks are tightening and that the growth outlook is hazy. So we have to think carefully about how much fiscal consolidation to do under the circumstances. But again, I'm aware that in arguing that issuing public debt to meet emergencies is a valuable function, I run the risk of empowering those who point to every event every year as an emergency. And there is that moral hazard that was described a moment ago. Second point, on the climate crisis, I think we need clear thinking about whether issuing public debt, and if so, how much, is an appropriate response to the climate crisis. We were just reminded of public debt issuance as risk shifting or sharing. To put it in another way, that there is a tax smoothing argument for issuing public debt. If you think that the climate-related investment we have to do now is a one-off, that we're going to have to do a lot of such investment for the next couple of years, after which normalcy, public investment-wise, returns. But if you think we are going to be dealing with the climate crisis, the public sector is going to be dealing with it for decades, then we're going to have to tax finance that investment. Subject to one caveat, which is if we're talking about public investment to in climate change abatement, we also want to think about the rate of return on that investment in terms of growth. Are those climate-related investments going to pay for themselves in terms of higher GDP or averting a collapse of GDP due to an adverse climate event? We don't know the answers to those questions, or when I read Commission communiques about investing in climate change abatement, I don't hear them discussed in those terms. But from a public debt point of view, those are the things we should be thinking about.
I think that's a great point. I mean, something that I found very interesting in your talk was this point about, the Netherlands financing efforts to, to stop climate-related issues 7 times over the course of the history. Are there any lessons we can take from their behaviour on how, how to do it and how perhaps not to do it too, given that you say it's probably not a one-off, it's mitigating a series of emergencies and challenges.
That was for me, Claire. No,
Yeah,
I
sorry.
think to come back to something that was said before, it is hard for democratic political systems, notwithstanding all their other virtues, to agree that the time is now right for fiscal consolidation. I would observe that there are some political systems, including the Dutch, that are better at this, and other political systems, like that of the United States, that are worse. That if you are able to build an encompassing political coalition where you can have an intelligent conversation and the costs of consolidation are widely shared, then the debt issuance and investment that you do upfront can be offset by consolidation. Later, if you're in a highly polarized political system with a first-past-the-post electoral system like we have in the United States, having an intelligent conversation about intertemporal optimization is hard.
Sure. Sure. Thanks a lot. I'd like to turn to the audience for questions in a minute. Before I do so, I'd like to just see if Daniela and Margit would like to say anything regards those remarks on the climate. Daniela, then maybe Margit.
Yeah. Yes, thank you. It feels like the left of to the Claire Jones has to provide some answers to the very. I have to say I'm a bit surprised to hear such a conservative fiscal position from the both of you. I mean, I don't need to remind everybody, but that EU public debt to GDP ratios is at around 100%, and without ECB holdings, it's around 65%, and without European central or without central banks. So the question of what is our capacity to borrow cannot be asked in separation from the question of what does the central bank do in order to shape that capacity to borrow. That's one thing. The second, I mean, we all share the criticism of the SPG. But I have not seen any convincing analysis to demonstrate that the structural need for sovereign bonds, for public debt in the private financial system in Europe has been taken into account to come up with a numerical, with a number that tells me this is too high public debt to GDP ratio, we should be reducing them. So until I see this, I don't find any convincing arguments. It sounds to me like we have created a very complicated theoretical framework to basically justify what is now, to me, an ideological position. We just don't like public debt. We don't like the state doing too many things. Let's just put that on the table, and then maybe we can have a different conversation about whether it is possible to continue to issue public debt for public good purposes for the climate emergency. To me, this is it's a serious emergency, and I cannot imagine how, for example, I imagine that there is some conversation between the Treasury and the Ministry of Energy here. How are you going to achieve renewable electricity by 2030 when you're at the same time fiscally consolidating? From what? Just from imposing on Austrian firms and households to start buying renewable electricity, then the market will respond? I'm very skeptical about this, allowing the market to kind of carry the burden of very significant transformations in the next 10 years. But this is what I hear from this side. Maybe I'm wrong.
Just very briefly, Harald, you said that there are probably 150 provisions to add flexibility into the Stability and Growth Pact, and this is not a very desirable situation, which I absolutely agree. It makes the thing complicated, and I think it doesn't help much in many cases. I think, however, we should kind of consolidate these flexibility provisions because they are not enough, I think, to cope with the green investment needs. So this is something we should focus on, that flexibility we need for green investment and probably also for the digital investment. I mean, the twin transition actually is the challenge we are facing, and get rid of a lot of other things and provisions for actual or alleged flexibility that don't help much, but make the whole thing intransparent and whatever, and complicated. And I mean, in Austria, there are probably 3 people or 5 people that are understanding the rules, not more. And Austria is a small country, but seriously, we have to get rid of a lot of these things.
Yes, on the need for debt reduction, no, it's not ideologically driven. It comes from my experience from the financial crisis. Because don't forget, if you're in a common currency, the element of market discipline, external forces, when you run irresponsible fiscal policies, is no longer there. And if we don't have that element, and if we say now's the time to issue more and more debt, it assumes, first of all, another element of moral hazard, a different one that I was talking before, because then it means the people who can bank on running unsustainable debt first will have to be saved by the others, which is exactly what happened during the financial crisis. And this is not a model that we can sell to our electorate. I don't think people would buy it, and it's also not a solid foundation for the European Union. That's why I'm against it. That's not really an ideological argument. On the green transition and the needs for financing, I think there are hundreds, maybe thousands of worthwhile things that we could invest public money in. But it does not mean that scarcity no longer exists. If we have something new and very important that we need to invest in, something else will have to become relatively less important, because at the end we're all faced with scarcity. And we should not pretend that scarcity does not exist, because we simply can't afford everything that's good all the time. This is an absolute uncertainty, and markets will not be willing to fund it. And there are additional things why maybe the ministries of finance are more skeptical than the environmental ministries. When somebody says, let's create special rules or exceptions for green investments, we are the ones asking what green actually means. And the problem is that green is not a scientific category, it's a political category, and depending on whom you ask, you'll get different answers, which is fine in a political discussion, but it's pretty useless when you try to draw up fiscal rules that apply to everybody. And just like Barry Eichengreen said before, we also tend to be a bit more skeptical when it comes to the growth projection. Because on the face of it, when we invest in sustainable technology, what we mostly do is replace existing capital stock without raising productive capacity. So we have the additional cost, but not the additional growth. And these are all reasons to be cautious. Maybe some of the targets are, well, if I'm euphemistic, I'd say very ambitious. Maybe some are even unrealistic. We'll see. But I'm also thinking that, you know, for an effort like that, you need a combination of public and private sector anyway. You can't shift it all to the public sector and expect that the taxpayer delivers all the solutions.
Just very quickly, Daniela, and then we'll turn to the audience.
Can I just say that from my rather constant presence on Twitter, the market actually doesn't want less public debt and doesn't want monetary tightening. It wants the opposite, because it's concerned of a significant recession and the demand destruction in the Eurozone. So I'm not sure which market do you speak to, but just to go back to the point, the existence of very significant large repo markets means that the private market itself can inject cyclical liquidity, and that can disrupt sovereign bond market. So I'm not sure that we can rely on the argument that market discipline will guide us into the relevant public debt to GDP ratio. I would say quite the opposite. Only the central bank can protect us from the disturbances that private repo markets can inflict on the sovereign.
Just briefly, I'd be very careful in confusing market sentiments with tweets on Twitter. Sorry, what was the other thing you said?
So it's not just tweets on Twitter, it's tweets of people who work in private finance and who go on in financial media and give statements and warn the ECB that premature tightening.
I'd also be careful, because in my function as chief of the risk committee of the ESM, I'm hearing different messages that maybe don't always make it to the media. But inflation is clearly a concern, and what it does to interest rate policy and what the effects of that may be. I would not be so sanguine on that. But there was a second part.
The second part was that we are going back to the trope of market discipline that needs to discipline the sovereign. And I'm saying to you that if we look at the trajectory of the sovereign debt crisis in the Eurozone, what we had was the market disrupting the European sovereign, not the other way around. So I wouldn't rely on it. I would rely on the central bank to provide
Now here, I also think, I said before what I said on the common currency, but at the moment, if you look at the debt situation at the global level, we have 70 to 80 countries at the moment that are threatened by default. So clearly there is a problem, and that problem can reach dramatic proportions if we basically pretend that it's not there.
Okay, so thank you for that lively discussion. I didn't want to get in the way there. But now it would be good to turn to the audience and get a round of questions. So can we have a show of hands, please? And then if we go first there, and then there, and then to the back, it'd be great.
Well, first I wanted to thank Barry, because I feel a bit responsible that you had to wake up so early since I invited you, and very grateful that you did that. Well, I wanted to bring one aspect in. I think I share a bit more the view on this side of the table than on that side of the table. But I wanted to bring an aspect in which probably was not raised, but from an economic history point of view, it seems to me a bit more like Ricardo's chapter on machinery in the Principles. We are living through a period where massive investment, fixed investments have to take place, and also in human capital, because digitization is not just equipping computers, but really a massive task of reskilling and training and shifting labor with new qualifications. And these are sort of all investments where the returns come quite a bit later than when you invest. So depending on the time horizon of private investors as compared to public investment, there's a difference of the inclination to undertake these investments. And I think we are in this very particular historical phase where this much more longer time horizon is required. Yeah? Therefore, I think the burden of public versus private investments shifts to me very much in terms of the public side. In Ricardo's chapter, it just went along with a fall of real income, so a fall of employment, because you moved out of producing things which the normal households require towards using the resources to investment. But we hopefully don't want this sort of transition. We want a transition which keeps people afloat while undertaking these enormous amounts of fixed investments, human capital investments as well as fixed investments. So I just wanted to see your view on that. And to Daniela, I wanted to ask, I think your point was really a matter of a scale rather than, because normally we always look at this formula and look at trend developments, public debt to GDP, but it doesn't define the level of debt to GDP. Yeah? So in that sense, we are still a bit in a black hole as economists. And your plea was there's quite a bit of scope of the upscaling, but not necessarily to avoid the question of runaway debt to GDP ratios. Is that right? Yeah.
The back and then in the middle, please.
Okay, thank you.
I have a comment question
Mr. Waiglein in particular, and that relates to framing the debate on the SGP. I mean, mainly in moral hazard terms, introduces inevitably, say, a negative bias in thinking, because I mean, it frames the debate as a zero-sum game, which means that, I mean, if one gains, say, a southern Mediterranean country, I mean, then a northern country, continental country may lose, or vice versa. Isn't there also a case to be made to think in terms of a positive sum game in the revision of the Stability and Growth Pact, insofar that, I mean, for example, I mean, moving at least partly into baby steps towards more common debt issuance to finance green investment could actually be beneficial for all, given that there are positive external effects across country borders, and we might get positive gains from moves in that direction.
And the third question, please.
Yeah, so I would like to hear a few words about the costs of fiscal consolidation, because we've heard, I guess, a lot about the costs of tax increase, or potentially that was implicit in the discussion. But I think that considering the climate change, we don't have actually good options, right? We either raise the public debt to finance things, or we tax the dirty industries heavily, so we can, you know, try to handle somehow the emissions, or we just don't do anything and we end up in a boiling planet in just 50 years, right? And then we all die, which is probably nothing, you know, not the outcome that we would like to achieve. Now, I'm fine with taxing the rich in dirty industries. I think it's fine, right? But there are costs to this, and maybe the proponents of that approach, or implicitly the proponents, would say a few words on that. Thank you.
So thanks a lot. So we've got a few issues there. One's this the time it takes for the growth payoff, and that leaving the private sector out of pocket for longer than it usually like to be. Whether we can have gold stars instead of moral hazard when it comes to the Stability and Growth Pact, and then this very good question about, you know, who can possibly be taxed and debt sustainability. Daniel, would you maybe like to go first, and then we go to Daniela, Harald, and Margit?
In my, let's say, long career as an economist, I have never encountered a period where people didn't say, now is really a need for massive public investment. Usually education comes first, and then, depending on the time period, investment in infrastructure, which we had in 1995, for example. Whenever we have a recession in Europe, we have big infrastructure programs. I think last year the Swiss inaugurated the Gotthard tunnel under budget, on time, and that was one of the biggest part of the 1995 trans-European networks. So it's I think, a usual refrain. Is it particularly strong this time? Especially when I hear talking about the digital infrastructure. Not so long ago, people said we have a secular decrease in interest rates because it is cheaper, capital has become cheaper, because digital investment doesn't require as much capital. So I don't think one can use the need for digitalization as a reason to say we need massive new public infrastructure. As I said, a couple of years ago, it was the opposite, right? Now, climate is different, which is very heavy in capital investment, because you build the stuff first and then it exists. And on top of it, you need to keep some of the old infrastructure for intermittency. That's quite clear. But actually, if you think about it and carefully and look at the numbers which have been published, you find that that part, the energy production part, is about 10-15% of the overall hundreds of billions per year which are branded around. Most of the rest is transport, And transport happens to be the cost of people buying EVs instead of, no, the cost, in the official statistics, it's the cost of people buying EVs, battery-powered cars. Not the difference between what they would have to buy anyway, right? Petrol engines, and because the difference is very small. So I think the numbers we are hearing branded around contain a lot of accounting for investment which would have to take place anyway. It just has to take in a different way. The direct investment for creating renewables energy, that is actually feasible, and you can imagine why that's the case. I mean, energy is overall 5% of our GDP, electricity much less. So if the cost of producing that increases a bit, it cannot be a very large amount. So I think you should be very careful with the statements that now is a time we need massive new investment at a significantly higher scale than in the past. And finally, why not finance it with debt instead of taxes? I think Barry gave an excellent argument why we should look at taxes. I think worrying about public debt is not just an ideology, it's a fact which countries like Italy have to take into account. Countries with high debt ratios pay a high risk premium. And that is a very significant cost, just in a normal regime, on top of the additional costs which come with what Barry said, that you have these what is the right or left-hand tail in the distribution when you're hit by a shock, and you already go into the shock with a very high debt ratio, and you're stuck. So I think we should really carefully consider the cost of high public debt in normal times and also in terms of limiting room for maneuver. Whether that cost starts increasing exactly at 60% of GDP or 65, I don't know, maybe you know better. But at 150, it is very high.
Yes, I mean, I just want to say that, of course, the increasing public debt is not the only way to go about dealing with the energy transition. There is on the table, for example, another alternative, which would be for the ECB to impose a decarbonization of private finance agenda that massively redirects financial flows from dirty to green activities, but somebody is saying no. Somebody who probably matters in that direction, no. But if this happened, then if you could have private financial flows going into green activities, of course, that would change the risk-return calculations. But my observations of the last year of the debates around the green agenda in the ECB is that the ambitions that Madame Lagarde had last year are not materializing, and we are seeing steps back in that respect. Plus the debates around I also want to raise this. I'm quite interested in the idea that we should save now or prepare now for the crisis in the future, because I understood that this was a German argument for not accelerating the energy transition before the Russian invasion of Ukraine. So I'm not sure that this is a powerful argument to me, that we will be better prepared if we somehow consolidate now when we are already in an emergency. So I think there are very significant costs to fiscal consolidation that we do not take into account, both for the private financial system for financial stability, but also for our ability to not only care about the environment, but I feel sometimes like I live in a different Europe, because in the Europe that I study in my research on private finance, there is a housing crisis in most large cities, there is a health crisis, there is a social care crisis, and this crisis will not be sorted out by private sector. Not with the cost of living problems that we have now. We need the state to go back to the social contract with its citizens, and that, to my mind, requires us to not think always the first question we need to think about when we think about the role of the state in the economy is, now we need fiscal consolidation.
I think this is really interesting what you touch upon here, which is this, it's like you said, the social contract, and in Europe there is this sense of there being, a willingness to have quite big government compared with, say, the US, and to look after citizens accordingly. But there's also this this issue where I think, as we started off the presentation with, it was l'état c'est moi. Now it's more like l'état c'est nous in Europe, where more and more weight is being put on the centre to really, honour this social contract. I mean, can that dynamic really work when there is this issue where the rights and responsibilities aren't as clear, just because you've got, well, obviously you've got the member states, but then you've got, what we're talking about here is European level spending.
I would just say this, that I think, to my mind, we have to think very carefully about what is happening in the political systems of European countries, and why is it that the far right and populist parties are gaining more and more support with a message, with an economic message that is very different from the liberal message of market discipline and low public debt to GDP ratios and consolidation. So to me, I think we need to go back to asking very fundamental questions about, is the social contract between European citizens and their states, is it weakening very fundamentally, which I think it is. There is evidence that this is the case, because the European states are no longer providing the kind of social support that they used to 15, 20 years ago.
I don't want to be misunderstood. I don't think that debt finance green public investment is the only and single solution. There are no simple solutions, as we heard from Barry Eichengreen. I totally agree. And I think, first of all, one measure that is absolutely important is to ensure effective carbon pricing in the EU and in member states, because the more effective carbon prices are, the more effective they are as incentives to induce private green investment, and thus to reduce the necessity for green public investment. Second thing, I absolutely agree. We have to redirect public spending. One big issue, also in Austria, but around the world, not only in Europe, but globally, is to dismantle environmentally harmful subsidies. Yeah? This just doesn't go together. Yeah? And this is also a fiscal and a budgetary issue. And a final, very general remark, I think we have to be aware that systematically investing in green infrastructure and also in green public infrastructure would help to avoid extreme climate events in the future, and would be associated, which probably would be associated with sizable and unpredictable public costs and costs for public deficits, and I think for public budgets. And I think we should stop focusing exclusively on the budgetary costs of climate action, but should also consider the budgetary costs of climate inaction. So this is a very general appeal I would like to make in the end. Thank you.
Yes, on the Stability and Growth Pact, maybe I wasn't clear enough. I think I didn't want to paint it as a zero-sum game, because there are several layers of agency conflicts involved. It's not just this moral hazard. I think the most important one is that an electorate and the government both have an incentive to shift the burdens of payments into the future. And so they collude. That's the most important agency problem and the moral hazard. And the other is the one I described before. When you're in a currency union and you have states with high debt and states with lower debt, then there can be the effect that we know from the financial sector quite well, the gambling for resurrection. And here it becomes very complicated when you raise the issue of the social contract, because I remember really well when Greece went bust and was not able to afford its debt and its expenditure anymore. We created 3 programs through the FSF and the ESM, raising sizable amounts by other European states, and I remember very well one discussion where Greece more or less brought the same argument as you. I mean, we're killing the social contract. And then the Lithuanian finance minister said, what on earth are you talking about? In Lithuania, people get 1/3 as minimum pension as you get in Greece, you're not reforming it, and you're asking my taxpayers to pay for it. So that argument is fair and well if you can afford it in your own country. But if you expect other countries to pay for it, then it's not okay. And that's not a question of the social contract. It's strictly irresponsible.
So I think we're pretty much out of time, but I'd just like to ask one final question. There clearly is an emergency setting in Europe. There's clearly an issue where, as Guntram Wolf spoke about before, Ukraine has quite it's in quite a perilous situation in terms of its short-term funding needs. It's got about a €5 billion monthly gap, and then there's the longer-term cost of reconstruction. Which some people have estimated at 1 trillion, some people 500 billion. Whatever it is, I think it'd be good to know what you think the number is. You're shaking your head furiously, but I think there are big costs involved. What role should the EU and the member states be paying in covering those costs for Ukraine? If we go from Harald through the panel to Margit, that would be good.
I think this has to be a global effort. I mean, this is a question for the EU to come up and deliver, and the Council is discussing this at the moment. But it's also a question for the international financial institutions, and I know the World Bank, the EBRD, and all the others are thinking very hard about that. And part of that may sound paradoxical now, but it's not as paradoxical when you think of it. The private sector plays a role. We need to help Ukraine becoming attractive to private investment again once the war ended. But make no mistake, in large parts of the country, the economy is up and running, shops are open, banks are operating. So it's never too early to think about the investment climate. And lastly, I think part of the answer in the end will also be the question of reparations paid by Russia. And this may sound paradoxical when I say it now, but maybe not so when I explain it a bit more. We have confiscated Russian central bank assets in the order of 300 billion euros in G7 countries. And it's quite clear that these assets will never be unfrozen before there's a solution to the conflict. It will not be done. So in the end, when there's a need to negotiate, and that time will come sooner or later, the Russians, knowing that they'll never get these assets back, for them it will not be a large step to agreeing that part of the assets at least can be used for the reconstruction of Ukraine. And that's something that's been legally done before. There's precedent for it. And it's quite different from the idea of confiscation that I'm also hearing, where I'm very skeptical because I fail to see how it works legally. But this would be a mechanism to deal with it, and the other mechanism, and I mean, this is not a secret if you look at market developments. I think debt restructuring in Ukraine will also have to play a part. And that can either be done by using Russian assets to pay for outstanding Ukrainian debt, or doing both and using the assets for the reconstruction of Ukraine. And just to give you an alternative scenario too, if you want, and that shows how mean we people are in the ministries of finance. If Russia really wants to claim 20% or more of Ukrainian territory and says this is now part of the Russian sovereign, under international law, that would make them also liable for the exact same percentage of Ukrainian outstanding debt, meaning you could sue them for it in courts in London, for instance, which are very good, and use frozen Russian assets as compensation. I don't know if you hold any Russian bonds, but I'm sure people will try that very soon.
Thank you. Daniel?
Very interesting considerations about, how to say, international financial diplomacy. Let me just say two things. On Ukraine, both reconstruction and providing the financial need which is now estimated, as somebody said this morning, 3 to 5 billion per month. That means 45 billion this year, and who knows next year. My view would be that this is mainly, not exclusively, but should be mainly a task for the European Union. We are the first ones to be concerned, and we all know that many countries in the world very far away, India, China, Latin America, they say, okay, Russia is a bit ugly there, but fundamentally it's a European problem. We are saying Ukraine is part of Europe, so I think this should be taken care of by the European Union. And then I apply the first principles evoked earlier by Barry Eichengreen. This is a war, so hopefully it's not forever, right? And this is the case for debt finance. And I think in this case, I would favor debt finance. What are the amounts? I mentioned earlier, this year 45, next year, I don't know. Hopefully it's not that long. And then reconstruction, 1 trillion. The entire Ukrainian economy was worth about 150 billion per year, right? Sorry, 1 trillion, that is just out of bounds, right? The usual estimate of the capital output ratio is around 2. That would mean that the capital stock of the entire Ukrainian economy should be worth around 300 billion. If it all were tabula rasa, right? So we are not talking about hundreds of billions here. We are talking about perhaps 100, but certainly not much more than, certainly less, I would say, than 2 percentage points of GDP of the EU. I think that we can afford in debt, and therefore I would say in this case it's debt, but it's not something which has a meaningful impact on our 100% debt to GDP ratio.
Okay, so let me agree with my colleague on the right that it is, I think, a responsibility of the European Union, and with my colleague on further right, I will disagree again. Or maybe I will qualify a question which is which private sector. I think the very important question for the reconstruction is will that reconstruction also recreate productive capacity in the Ukrainian economy so that it generates a sustainable economy for the future, and paying, for example, German companies to reconstruct Ukraine is very different from giving grants to the Ukrainian government to create private Ukrainian firms and public Ukrainian companies to do that. And I have a suggestion, since we are in Austria. In Austria, if you remember, after 2008, around 2011, when it was still kind of popular, I see it's not so much anymore, but then it was quite popular to question the optimal ability of the private financial system and of the market to deliver us from all the evils that we are confronting. Austria was one of the countries that proposed a financial transactions tax that was supported by Germany, was supported by France. Maybe it's time to revive that, but a green financial transactions tax, this is you're my barometer for my progressive proposal, I suppose, or not. A green financial transactions tax would do 2 things at the same time. It will raise money for Ukraine, while at the same time it will punish and disencourage private investment in fossil fuel activities, which is what we want. And we have a way of working out, just to finish in this parenthesis, we have a way of working out which companies are engaged in which kind of activities. I don't want to disparage completely the work of the European Commission. There is a sustainable finance taxonomy there that has some useful things in it, whatever you think of natural gas and nuclear.
Well, I don't have have much to add as the last one in the row. I agree. I don't think taxes are a good way to finance that. I think that financing would be preferable. I think costs are manageable, and I think that it's probably really primarily a task of the EU.
Thank you. And can I just give, I'd like to give Barry an opportunity to give his point of view as well. Thank you. And also, I think Daniel's got a car waiting outside, so I think he's going to have to leave now, I'm afraid. But just to thank Daniel briefly, thank you. Now, Barry, over to you.
My ballpark estimate of Ukrainian reconstruction costs is $150 billion because that was the size of Ukraine's GDP before the war, because my guess of the capital output ratio is 3, and because my guess of the share of the capital stock that will be destroyed is 1/3. How should it be financed? I want to make an argument against reparations. It's clear that foreign aid will have to meet Ukraine's immediate needs, but after that it will have to attract private foreign investment. Private foreign investment will go in only if the security situation is adequate. Future Russian governments will have to acknowledge and respect the territorial and political integrity of Ukraine. And if that's what we want future Russian governments to do for social reasons, humanitarian reasons, and in order to attract private foreign investment into Ukraine, then history tells me reparations are the last thing we want to superimpose on a difficult Russian political economy. Everybody here knows 1920s history, and I think that's a cautionary tale.
Thanks a lot. So I think I now have to bring this session to a close. Thank you so much, Barry, for giving such a fascinating presentation to begin with, and also for sticking around and giving us your remarks on a few of the questions and what the panelists had to say. I'd like to thank our panelists as well, who I think have done a great job of, really ending this today on a high, and also to just thank the Institute for doing a really great job today, and happy birthday from all of us. So.